This business boils down to one thing, and that's the preservation and growth of capital.
You were looking for companies that are creators of capital, not consumers.
If your enterprise is not creating more capital than it is consuming, and that persists over the long run, you're gone. Let's start in the U.S. Clearly a globally leading economy, clearly the reserve currency of the world, but we think times are changing. Everybody is now a little nervous about the dollar. You now see foreign investments coming into the U.S. with the dollar hedged. That's a big change. The S&P is more concentrated than we've seen it in 70 years. The Germans are being deindustrialized by Chinese import. The UK, the consumer, has tucked in like a turtle.
You can go where the opportunity is. You're not shackled by a geographical filter.
There are no borders. It's capital. It just gets different symbols put in front of it, but at the end of the day, it's all capital. It always has been.
Hi, my name is Bernard Paternina. I'm a portfolio manager at Silvercrest, and I have the privilege of serving a small number of families here. And I'm joined by Chris Richey, our resident expert in all things international outside the U.S. How are you, Chris?
Bernard, it's great to be in New York City.
It's good to have you here.
Yeah, it's nice to come to headquarters.
You're based in San Diego, correct?
Absolutely. Yep. Been
That's
there
wonderful.
35 years now.
That's fantastic.
Yeah.
One of the things I find most special about our firm is our access to intellectual capital. So generally, someone in my role outside of this firm might not have the capability of sitting down and having a close discussion with someone in your role, which is, you're more focused on a specific part of the portfolio.
Yeah.
And generally the distance between our roles is fairly wide, fairly substantial. So I enjoy the fact that, you're just a phone call away or a plane ride away,
Yep.
and I get out to San Diego to visit you. So that's something I very much appreciate about the firm, and being able to pick your brain about different things on the macro side. So I just wanted to start the conversation, take a little bit of a view on your historical performance. I think that you're definitely too humble to brag about this. So maybe I'll do a little bit of the bragging for you. You've had a phenomenal run. I know you keep saying, past performance is not indicative, and
Yeah.
but I think we have to celebrate, the success that your team has achieved for our clients. I'll tell you, my clients are tremendously happy with what you've done for the portfolio. So thank you very much for that.
Well, we're glad to be of service. That's our job here, is to be the international ex-US investors overseas, find value, help your clients preserve and grow their money, and help our firm grow as well. So that's our expertise. We land is in the international markets, non-US. We run a global product, so we have some awareness of US through that product, but primarily we're ex-US in large cap all the way down to small cap, out into emerging markets across 5 portfolios that have track records anywhere from 6 to 21 years. And we've been working those fields much longer than that, going into the 90s at a different firm, doing the same thing. So we're into 3, approaching 4 decades of doing what we do, the style that we do it, the manner and unique way that we do it, which is concentrated portfolios, much more concentrated than you see other portfolio managers manage. We manage a 15 to 20 stock portfolio in global and international. We manage a 30 to 40 stock portfolio in international, in global, and in emerging markets. And then we run a small cap portfolio of 40 to 50 names, sorry.
And your concentration speaks to conviction. I mean, you wouldn't run these portfolios as concentrated as you do if you didn't have a significant amount of conviction in each one of the portfolio holdings that you have.
Absolutely. I mean, when I started in the business in the early 90s, the benchmarks were a theoretical investment opportunity that you would compare yourself against, but only as a theoretical. The funds, the ETF funds, the index funds really didn't come about till the early 2000s. So now there is an alternative where you can get that benchmark return at a very low price. So active managers have to prove their worth in their portfolios. That's measured by what's called active share, how different you are than the benchmark. We're generally 90 to 98% different from the benchmark in our allocations. And if you look at the benchmarks, there's 2,000 stocks generally in any number of these benchmarks. That's not where we play. We play down in high conviction 2 to 4% positions in the 30 to 40 stock portfolios and 4 to 6% positions generally in the concentrated portfolios. But there's no sense indexing anymore in terms of being an active manager, because the clients can get that now and at very cheap prices, 5-10 basis points. It can, and it is a legitimate, very good portion of anyone's portfolio where you don't advocate against passive investing at all, but you need to overcome some of the problems you get in index investing where you get sucked into every problem out there in the world. We think you go focus on the enterprises, depend on their ability to create and accumulate capital on your behalf, because as we've talked about a number of times, this business boils down to one thing, and that's the preservation and growth of capital at the individual level, at the company level, frankly, at the society level. It's primitive view, but in our job, that is it. We are capital managers for people, right. And that's what they depend on us for.
Right. One thing I admire about your team is you stick to your knitting so much. You're very loyal to your process, and independently of whether markets are in your favor or against you, you really are steadfast in your process. Could you talk a little bit about that?
Well, it's very bottom-up driven. We're macro aware, but we start at the individual enterprise. We screen for our securities and then run a very extensive process of trying to understand if those numbers are legitimate. Most companies don't make it over that bar. I mean, if you run a 20 stock portfolio, you're clearly rejecting 1,980 stocks right. out of the universe.
Most of the
so most of the time, it's either a playground we can't play in terms of those higher price stocks. And again, we're value investors, so we're looking for discounts to intrinsic value that give us a big enough margin of safety to take the risk to own that company, that the upside is worth the risk of getting in. So the process is bottom-up driven, very quantitative at the front end, but then we do an extensive deep dive on competition, the market, the country, the regulations, all that stuff. That's really where more the creativity is, and experience and insight comes to bear is at that back end. Everybody can run quant screens now. Everybody can back test now. These are all things that when I started out were expensive, difficult, and inaccessible largely. Now, the tools you have as an average person using Yahoo Finance are far in excess of what we had in the late 80s and early 90s. So we try to make our experience with, frankly, these indices over 40 years now almost, a starting point. We'll know a lot of the names already. We'll have invested in many of the names already. But it's all bottom-up driven, macro aware, with the idea of a 3 to 5 year investment time frame and a good margin of safety, what we call a good margin of safety of 20% plus at the point of entry. So it implies a 20% upside at the minimum.
What was you had a comment the other day when you said you were looking for companies that are creators of capital, not consumers. Did I get that right?
Absolutely right. At the end of the day, if your enterprise is not creating more capital than it is consuming, and that persists over the long run, you're gone. I mean, that's just the name of the game. It's a cruel world. It cuts across any industry anywhere on the planet. It doesn't matter if it's in China or the US. Everybody is focused on capital creation, capital retention, capital growth, returns on capital. And so that's where we direct our focus, is down on that fundamental fact about these enterprises. Are they growing capital at reasonable and sustainable rates with a balance sheet that we're comfortable with? So we try and almost like take things down to the atomic scale right. in a capitalist economy, which is capital. So that's where we put all our time.
I like that lens. I like that lens a lot.
Well, it's a complex world.
Right.
There's a number of ways to assess. I mean, there's people who look at the other end of the telescope than us, right? And they start at the macro and then winnow down to the company level idea. We start at the company level, and the portfolio gets created from that. It all adds up to a portfolio with certain guardrails, with limitations on individual position sizes, sector sizes, country allocations, and of that matter, to make sure it's diversified, because these are concentrated portfolios. So you need, the safety of diversification. But mathematically, I mean, we've known this for 50, 60 years now, all the diversification, the mathematical diversification effects are all captured in that first 20 stocks. Most of your risk and volatility can be mitigated in 20 correctly picked stocks in the right place and with somebody watching them constantly.
That's fascinating because you mentioned the ETFs that launched around 2010, and they do definitely give the appearance of diversification, but it really is just that, right? It's just appearance of diversification as opposed to actual diversification.
It's diversified, but it's you're taking in a whole lot of bad risk that you don't need to have in that circumstance, that you can, if you find a trustworthy stock picker, portfolio manager, can get rid of the risk out of the portfolio that you don't want. Balance sheet risk, regulatory risk, loss of market share risk, non-competitive position, et cetera. I mean, those things we try to winnow out right at the start. And that leaves us with a universe at any given time of probably about 100 to 150 names that are in the on-deck circle that haven't quite made it into the portfolio, but that we prioritize as to what are the most attractive targets. If something needs to go out, if we need to pare back positions. So the idea is to keep it simple, focus on what matters, start at the company level, work your way up, make sure it's a diversified portfolio with regard to the risks across it, and then show some patience and be on it constantly. Because it's not a 5 day a week, take 2 days off type thing. Right. It's a 7 day a week, all year long. I mean, I started my own company 25 or so years ago, and you just really can't step away from it and step back into it on a part-time basis or anything like that. It's full-time to stay up on all the regulatory, currency, war, everything is everything is in the mix here when you have an international portfolio or run global portfolios. You have to stay on it.
One of the conversations I have a lot of fun with you on an ongoing basis is your macroeconomic view. I'd love if you could just take us a little bit around the world, show us what opportunities you're seeing, what risks you're seeing. I bet as a value manager, the number of risks are probably larger than the opportunity set, just given how your mind works. But
yeah, I mean, we are by nature, value investors should be cautious. I mean, it is a cautious strategy in insisting on doing fundamental analysis and having a margin of safety between what you think is a fair price and what is being offered. Macro-wise, let's start here, where we live. Let's start in the U.S. Clearly a globally leading economy, clearly the reserve currency of the world at the moment, et cetera. But we think times are changing. I think part of the reason you're seeing that change is the shock of Liberation Day and what happened to the external money we had coming into this country and investing in this country. We talked about this earlier today. It used to be unhedged. When non-U.S. residents used to invest in the U.S., you took the dollar and your dollar risk as is. Since Liberation Day and back, just last month, you now see foreign investments coming into the U.S. with the dollar hedged. That's a big change. That tells you something. Right. This used to be the flight to safety was into the dollar. Now, we'll go into the dollar, but I need to hedge my risk on that. And I think that represents a substantial sea change in the environment and what we're likely to see in the next 10 to 20 years. We're exiting the post-Cold War world. Where, the end of history and all that. And we're moving into a bipolar world. Between
bipolar and multipolar. I've heard
multipolar,
both, right?
It's going to be the U.S. and China.
Right.
Short of a Chinese meltdown. And they have had 4 revolutions in the last 170 years. So be aware of that. The surface of the water may be still, but there's turbulence underneath it in China. They keep a lid on it, but I would never count that out as a risk of China. I mean, there's just very much government risk in China. That's still the case. Let's flip to that. Let me just address the U.S. real quick. The S&P is more concentrated than we've seen it in 70 years at this point. It's priced higher than it's been in eons, probably before the go-go years of the 70s. Our global product is underallocated to the U.S. The U.S. constitutes 65% of that global benchmark. we're only at about 29% because we just don't see the number of opportunities in the U.S. that we're seeing overseas, where in aggregate, stocks are selling at a 35% discount on a PE basis to what you can buy here.
That's a big
That's
statement.
intriguing. Yeah, that's intriguing as a value investor. I mean, you've got to go where the value is or we're going to be called liars.
Right.
So we're pushing more of our money overseas. In our international portfolios, they're always obviously overseas. We don't
Right.
cheat and put any U.S. products in there to juice returns. It's purely international product. China has been a good opportunity for us, but we've been underallocated because we are concerned about the information. The Chinese are also overproducing electric vehicles, solar panels, and lithium batteries at a ferocious pace. They can't consume all of that internally. They're having to ship it overseas. They like shipping it overseas. The U.S. has called a halt to unrestrained imports into it, but Europe is still receiving tons of goods. Can't really object to that with the Chinese because of how much they've invested in China at their end. So that's a little concerning to us on their behalf and Europe. That gives us pause in Europe. But we think the long-term prognosis for China is good on its present path. We don't believe in any of this conversion to democracy that was some wish people had in the late 90s and early 2000s, that by pushing China further into the capitalist system, that would result in democracy. That is not going to be the case. China has prospered over 3,000 years with autocratic, capitalistic undertones to their society, and that's how they will continue to prosper going forward. I don't know if there'll be a change of government at some point down the line. I'm sure Chinese intelligence authorities don't want to hear me talking about that, but change is always in the offing. Europe, performance has been very good in Europe, despite, I think, a lot of macroeconomic issues. The French cannot seem to form a permanent government. They can't get their budget under control. The Germans are being deindustrialized by Chinese imports, particularly in the auto industry. The UK, the consumer, has tucked in like a turtle and is spending less than they did before COVID, which is concerning there. And maybe that's a post-Brexit impact. So it's not all sunshine and roses overseas. I mean, performance has been good, but it's been not because of the macroeconomic conditions. It's been good because we've worked very hard at our stock selection and our discipline and our holdings, et cetera. Performance year to date has been outstanding, and over the 1, 3, 5, 7, 10, and sometimes going back to inception in those products. That's great. On a peer basis, we're doing very well. Relative and absolute, couldn't be happier, but we're paid to worry, so we're worried. we were paring back today. Just before this, we were paring back our portfolios in infotech, and in some stocks that have starting to get out of our range. So
the weakness in the dollar this year has been a fairly substantial tailwind for you as well, right?
Absolutely. After 15 years of fighting that headwind,
right?
We've been predicting it. We've been predicting dollar weakness in 10 of the last 10 years. It's finally coming to bear. It's stalled at the moment, right? We've seen about 10% come off. It's bounced back. But I think that hedging discussion we had earlier is very much on point. Everybody is now a little nervous about the dollar. I mean, how are we going to get out of our debt if we don't slightly inflate the economy at a controllable rate? And does that get away from us? Right? That 3% inflation rate helps offset all the 127% debt to equity, national debt to equity that we have. So there's going to be inflation, and that's going to weaken the dollar. But the truth is, I don't think we're moving away from a dollar world because you have to have an alternative to go to. The renminbi is not freely tradable. That's the Chinese currency, not freely tradable. You're seeing more of it being used in loans around the world, and the Chinese are wanting to get that currency out there, but they don't want that level out of their control. The yen, still extremely weak, likely to get weaker if they run their deficits and debt up even further. The euro was supposed to be the great challenger. Just hasn't cut it.
Doesn't appear to be the case.
No, the European Union suffers from the same problems this country had under the Articles of Confederation, which is the basic problem of, hey, who's in charge here? Right? I mean, somebody has to be in charge. Nobody's in charge. So who's driving?
Also, I think that culturally, that you've got very different cultures that are sort of shackled under one monetary policy.
Yeah.
And different cultures and different economies as well. So it's difficult. Some of them need a weaker currency. Others would enjoy, a stronger
currency.
So, right.
It's almost cultural. The north to south divide in the EU is humongous. Although best performance in the last 2 years have been Spain and Italy.
There you go.
So again, macro problems do not necessarily mean bad returns. It means you just have to be more selective. And if you don't find anything that hits the criteria, you're just not there. So we're not in all countries. In fact, we're probably only in internationally, probably 13 to 14 countries.
I like that. You're free enough where you can go where the opportunity is. You're not shackled by a geographical filter, if you will, where you have to be.
I mean, I don't want to say it's a borderless world. It's clearly a world filled with borders and conflicts over borders. But as far as our job is concerned,
right.
There are no borders. It's capital. It just gets different symbols put in front of it. But at the end of the day, it's all capital. It always has been. It just has slightly different symbols in front of it. And that's our attitude. Now, we don't want to be any place where we think there's regulatory risk, political risk far beyond our control. It's all beyond our control.
Sure.
But pretty much everything is on the table. If it's liquid, investable, we have faith in that government. We have faith in their currency, reasonable faith in their currency. We will go there. We will take a look.
Rounding out your process, it wouldn't be 2025 if I didn't ask you an AI question.
Yes.
How do you use AI as a tool? First of all, is it even useful for you? And if so, what are your findings?
I've been working with computers since I was in middle school in the early 70s. And if you're not embracing technology, you don't have to be on the bleeding edge, but you need to work with it, because it's not all waiting. The world's not going to wait on us to figure it out. We do use it. We use a product called Essentia. Essentia looks at the performance of our portfolios, looks at all our decision making, and tells us, because it's a huge amount of data, buys, sells, pairs, adds, all that is very hard to analyze, frankly, with traditional spreadsheets. AI gives us the capability to take a huge data set over multiple years, at this point 6 years of data on these portfolios, to break apart our decision making, our prior decisions, and tell us, based on our peer group, et cetera, where we excel and where we lag against our peer group. And what it tells us is we're very good at stock picking. We're very good at picking points of entry. We're very good at top ticking, exiting at the right point. But like many value managers, we have a tendency to be early, and we have a tendency to persist where we should quit. We've put now in a trigger at the 9-month mark after we initiate a new position for us to deliberately go back and look at it, particularly if it's underperforming by 5 or 10%, to make us go back and look at it. But it's a struggle, because a lot of the returns we get, I mean, if you've looked at the performance of our portfolios, you break it down, we are early. And if you bail out at that 12-month mark, in a lot of instances, we'd give up 300, 400, 500 basis points of alpha.
Wow.
So that's the trick. What is the difference between persistence and stupidity when it comes to managing a portfolio? And that's where the real art is, and you don't always get it right. You try to be more right than wrong at a level that satisfies the client's risk appetite.
Right.
And it gives them returns thereafter, and the capital preservation allows them to sleep at night. That's the most important thing. If you're invested in a product where at 2 a.m. you wake up and you think, what is going on? With that, I have no idea what they're doing. That to me is the worst feeling in the world.
Sure.
So
Sure.
I like to sleep at night.
Right.
I don't like to wake up in the middle of the night worried. And that's how we run the portfolios. We try to keep them good, with good balance sheets, good market position, growing revenues, growing earnings, good dividend, et cetera. Those are all the hallmarks of but they don't all meet that criteria.
Right. So you're using AI then more to hone in on your process.
Yeah.
Fascinating. And how to improve.
Yeah, I mean, and it's at the back end of the process. So we're not risking anything other than if its analysis of where our decisions are is wrong, but it looks right. We intuitively knew this 3 and 4 or 5, 20 years ago, winners and losers. But frankly, I mean, this may be unusual to say, I welcome the day we have a truly educated AI agent involved in our process, listening into our meetings in real time, recording, noting it. I mean, we can already do that with Zoom and
Right.
et cetera. I'd welcome that. I mean, we can always shut it off. We're not going to turn it loose and give it the power to execute the trades.
Right.
But I'd welcome that more perfect memory. And if you can, give it the role it's supposed to play, the mentality it's supposed to have, and educate that agent enough, it would be another voice in the room that's perhaps more objective sometimes than any of the 6 of us sitting in that particular room that day. So I'm embracing it. We're embracing it.
Good.
And I'm looking forward. I mean, I hope I live long enough in this world to see that, because I've found technology has been a tremendous boon in my life, both professionally and personally. Yeah, sure, it can get out of control. You're driving your car now
or is the car driving you?
Yeah, is the car driving you? It jerks the wheel, et cetera. We are living in very interesting times with regard to our relationships with technology. 100 years from now, I'll be very interested what they look back and see about how we adopted this and used it. So I'm excited. We're not fearing the future at all. I wish it would come here sooner. I'd love to see better technology. 95% of all these AI agents to this point have not fulfilled their promise.
Sure.
Right? That's a statistic I saw the other day. I don't know how accurate that is, but
Sure.
it sounds intuitively right. You wouldn't turn any of your decisions over to an AI at this point,
Not
right?
at this point, absolutely not.
Right. So it's just not there, but it will get there.
Sure. Well, wonderful. Chris, thank you so much for your time. Thank you for your expertise. I could talk to you all day.
We do. We'll go talk
We
now.
do. We'll talk later. Thank
right.
you very much.
Thanks,
And,
Bernard.
have a wonderful flight back home.
Thank you.